I think that we have to see oil prices in sort of a higher for longer range. As you said, I don't think that necessarily means we're going to see it spike to $250 a barrel or something crazy like that. We might if there's some sort of a supply disruption, but I think more likely is that the average price of oil over the next several years has to be at a level which incentivizes the level of investment needed to bring new production projects online.
And we're not there right now.
We're not there right now. I think it's probably more like $90 a barrel. One thing I look at is, what does Saudi Arabia need, right, to balance its own internal budget? And
90 bucks a barrel, right?
Yeah, $90 to $95 a barrel. And of course, now that'll change over time, right?
Elliott, how's it going, man?
Good to be back on the show.
Yeah, thanks for coming on. Just last time we talked about, or last June when we talked, we were talking about, let's start with oil. We were talking about oil. I want to say oil was just started to go up, started to run. We were in the high 60s, low 70s-ish, if you would. And fast forward to 6 months later, we're really back where we were. Right. So tell me, and I know we were both very bullish on oil going into the second half of 23, which was partially correct. We had a pretty good spike up into the mid 90s. I want to say in the October area, and then it fell out of bed again. Right. But yeah, what's your projections here going into 24?
Yeah, I actually think the oil market's a lot tighter than in terms of the supply demand balance. It's a lot tighter than most people think, and a lot of most analysts are predicting it to be. There are really obviously there's two sides to the oil market, right? You've got supply and demand. On the demand side, there was some signs of weakness in oil demand here in the United States, sort of September, October. Part of that was just a function of price, because as you mentioned, prices did spike up there into the 90s. Gasoline prices were relatively high. So there is a little bit of demand weakness, but it's well within the 5-year seasonal range. And more recently, we've actually seen a little bit of a demand rebound here in the U.S. Globally, there are some signs of, a sort of squishy oil demand, but certainly nothing to be too concerned about. I still think global oil demand will grow in 2024. Honestly, it very well could grow even if there's a recession, because you still have very strong growth, especially from emerging markets. I actually think the bigger concern from the market's perspective has been the supply side, and in particular, U.S. production and U.S. production growth. You've probably seen the headlines. They've been sort of all over the mainstream media about, U.S. oil production being at a record high. Particularly production from, U.S. shale fields like the Permian Basin of Texas and Mexico being very strong. And you've even had some pundits out there saying things like, well, we're back as we were in 2014. If you remember back in 2014, and by the way, nothing scares oil traders more than discussions about late 2014. But if you remember kind of what was going on back then, from 2010 to 2014, roughly, oil prices sort of oscillated around $100 a barrel. A little higher if you were looking at Brent, and sort of around 100 on WTI basis. And the main reason for that was U.S. oil production was growing at a very rapid clip. We were seeing growth 1.5, even up to 2 million barrels a day each year from the U.S. But Saudi Arabia and the rest of OPEC were kind of offsetting that to some extent. They were limiting their own production and trying to support the price of oil around 100. Sometime in 2014, they realized that what was happening, right, was they were cutting their own production to support the price of oil, which is essentially just writing a check to all the shale producers to continue drilling like crazy, borrowing money, outspending their cash flow and everything else. And so OPEC flooded the market with oil to drive down the price, to punish shale producers and also sort of wayward OPEC members that were constantly cheating on their quotas. So there has been some theory. You've actually seen some pundits say, well, the same thing's going to happen this time in 2024, right? U.S. oil production growth is at a record, or the U.S. oil production is a record. And therefore the Saudis are going to give up on managing, cutting their own production to manage oil prices. I think that's highly, highly unlikely. And I think the comparison between 2014 and 2024 is not a good one. The main reason for that, two main reasons for that. First of all, US oil production is growing. It was expected to grow this past year, but I don't think it's growing as much as people think. Most of those numbers are based on data from the Energy Information Administration, the EIA. And it's part of their weekly and monthly petroleum status reports. And so basically what they do is they estimate, US oil demand, US oil inventories, US oil production, imports and exports. And in recent years, really since the shale boom really started to take off in 2011, 2012, they've had they have an error term they call the adjustment factor in their data. It's to make the numbers balance when they don't add up, because they independently estimate all these aspects, including production. And if the numbers don't add up, they add sort of a fudge factor, if you will, an error term called the adjustment factor. And that had been very consistently positive, which means for many years, they've been underestimating US oil supply. And starting last year in June, they started revising the way they calculate this data. They started revising it from June forward, but they did not backwardly revise their data from, say, 2022, 2021, et cetera, past. So what that did is it got rid of that error term and the adjustment factor. It reduced it somewhat. But, and part of that was it showed higher US oil production. But numbers since June are not directly comparable to numbers a year ago before they made this adjustment. So US oil production isn't growing at 600,000 or 700,000 barrels a day over the past year, as some are suggesting. It's probably growing more like 200,000 or 300,000 barrels a day year over year, which is nothing like the growth we saw back in 2014. The second aspect is related to the merger and acquisition boom that we've seen here in the US. You saw Exxon buying Pioneer, Chevron buying Hess, and there have been a lot of smaller deals as well. And a lot of those deals involve private companies. Now, privately held producers in the Permian Basin produce the 20 largest alone, produce over 1.6 million barrels of oil equivalent per day. And all of them are looking to sell themselves to the highest bidder. And typically in a private deal, when you have a company like Exxon or Occidental more recently, for example, and you want to buy a private producer, the valuation you pay is based on that producer's acreage, how many net acres they have, but also per flowing barrels. So in other words, it's based on their production, ongoing rate of production. So guess what the private producers did early last year and in late 2022, they drilled very aggressively to dress up their valuation so that when it came time to sell, they would get a better valuation. So we saw names like Capstone or Crown Rock, which was just bought by Occidental, ramping up their production. Newborn Oil, which is another private producer that hasn't received a takeover offer yet, but that's where all the aggressive drilling has been. Several of them have already been acquired. 6 of the top 20 have been acquired since the beginning of last year. And we're already hearing from companies like Halliburton that they've slowed their drilling activity. Mission accomplished. They ramped up their oil production. They're getting takeover offers. They're selling themselves to the highest bidder. And typically what happens is when the producer takes over that privately held producer, they don't continue to drill aggressively, right? They cut their capital spending, try to show free cash flow to dress up their valuation on Wall Street. Because what investors want, they don't want companies out there spending billions and billions of dollars more than they generate free cash flow operating cash flow to produce more oil. They want to see free cash flow, dividends, share buybacks, debt pay downs, that kind of thing. And so, what we saw is this rush of production from these private guys. As they get acquired, we're seeing that production come down again. And so I think as we move through 2024 this year, I think you're going to see increasingly those production figures either roll over or the growth moderate. And I think there's a risk, bigger risk longer term, is that we go from saying, oh, well, there's too much shale oil production to saying, hey, you know what? The Permian Basin is probably close to its peak level of production. Mm-hmm. It's a maturing play. It's an amazing play. And it does have some growth left in the tank. But you got to remember, these big oil companies aren't buying acreage for the fun of it at high prices. They're buying it because they want to establish access to resource and a drilling inventory for the future. Typically, that's what you see as a basin matures. You see the big players come in and snap up as much acreage as they can to make sure they have enough inventory to support years of production. So I think the oil market's going to be your risk on the consumption side. We have a recession, you'll see some dips. But I think the idea that we're going to see prolonged prices down in the low to mid 60s is unlikely. I think the chance that Saudi Arabia doesn't understand what's going on and how it's different from 2014 is almost negligible. The Saudis, sometimes I think they're portrayed in the media as being sort of, untalented with forecasting things, but it's the exact opposite. They have a bird's eye view of the entire global oil market. They know what's going on, and they know what's going on in the US too.
Mhm.
So I think it's going to be a lot stronger than people think. And the supply demand balance is going to remain tighter for longer. And longer term, the conversation is going to turn to, where are we going to get all the oil we need to meet global growth and demand, which continues apace.
Yeah, there's so much going on with what you said. Thank you for that. I think it's really, and I'm going back to our conversation last summer. It was you mentioned and discussed that it was going from a demand issue, for lack of a better word, to a supply issue.
Mhm.
And we might not have the price that we thought it was, but I think we're very much, and you can certainly please comment on this, we're certainly in that supply issue now because like you, I'm looking at all of these inventory reports, which they're very tight,
Mhm.
surprisingly tight. I read an article just today about how Iran is pulling some of the supply back from China just to get oil prices up.
Mhm.
And then the OPEC recent cuts, I believe they're hitting this week or they've already started to hit.
Right.
I was a little confused about why the price was down and you answered that question. But I guess now it's like, where do prices go? Which it seems like we're both in agreement that, well, supply is tight. We don't know exactly where the price is going to go, but supply is tight. But I can see a situation where we go high, and I'm not talking $150 a barrel, but just higher than where we're at really, really quick.
Mhm.
And what are your thoughts on that?
Yeah, I think that, oil cycles only end through investment, right?
Mhm.
So if you go back to the 1970s, which was the last sort of big super cycle in all commodities, arguably one of the biggest super cycles in history. A lot of people think the Fed brought down inflation, but on the commodity side, it really wasn't the Fed that brought down inflation in the early 80s. It was
The
the
North
fact
Sea and Prudhoe Bay, right?
exactly. And Cantarell in Mexico and
Right.
all this non-OPEC spending. So it was spending, it was investment. And why do private oil companies mainly invest in exploration production? They do so because the price of oil is high, they can make more money that way. So usually when the price of oil rises, you see an increase in capital spending. We haven't seen that this cycle yet. Capital spending is still kind of locked really back at the lows we saw, except for 2020, back in 2016, 2017, when oil prices were much lower. One reason for that, in my opinion, is what I like to call greenflation problem, which is basically just that you have all this ESG investment sort of criteria that have been added to by a lot of money managers, and they've avoided the energy sector. So the energy sector is seeing a big increase in the cost of capital, irrespective of prevailing interest rates. There was a Goldman Sachs study out, I think it was near the beginning or middle of last year, and they were estimating the cost of capital for low carbon projects, like alternative energy investment versus say the traditional oil and gas, so higher carbon um, investment. And they were seeing a 15 percentage point higher cost of capital for a traditional high carbon or fossil fuel project. So people say, well, rates were really low. It should encourage investment. Well, it doesn't matter whether interest rates are at 0 or 5%. If your cost of capital is 15 percentage points higher because you happen to be in an industry that is, being sort of avoided like plague because of, ESG criteria. It's beginning to change, but it's still an impediment for a lot of countries and a lot of companies. You look at British Petroleum, or what used to be called British Petroleum, BP, Shell, all the European majors. They had planned to allow their oil and gas production to decline in coming years, right? And they've reversed that now to an extent because they see that bigger problem right now isn't really the carbon issue, it's energy security and spiking energy prices in places like, Europe natural gas. So I think that what's going to actually, I think that we have to see oil prices in sort of a higher for longer range. As you said, I don't think that necessarily means we're going to see it spike to $250 a barrel or something crazy like that. We might if there's some sort of a supply disruption, but I think more likely is that the average price of oil over the next several years has to be at a level which incentivizes the level of investment needed to bring new production projects online.
And we're not there right now.
We're not there right now. I think it's probably more like $90 a barrel. One thing I look at is, what does Saudi Arabia need, right, to balance its own internal budget?
$90 a barrel, right?
Yeah, $90 to $95 a barrel. And of course, now that'll change over time, right? So if there's, 10% inflation over the next year or something, obviously, that break-even price is going to go higher. But I think that's a good estimate right now. And I think it's going to have to remain there for some time. We mentioned the 70s, but if you look at oil prices in the 70s, even on an inflation adjusted basis, they rarely ever even were flat for a couple of years.
Right.
Around the recession of 74, 75, oil demand was flat globally or down slightly globally, and prices were kind of flattened out on an inflation adjusted basis. But then they took off again because they need to be high on an inflation adjusted basis to incentivize the supply growth that you need. And,
right.
A lot of the things that were expected, that were talked about to reduce global oil demand haven't come to pass. For example, I remember a lot of articles a year ago, 2023 was supposed to be the year of the EV here in the United States. We have a bunch of new EVs coming on the market. The F-150 Lightning, the Ford F-150 pickup, that's actually the best selling vehicle in America. And you had people saying, well, this is going to be the biggest selling EV of all time. They recently cut their production plans for next year. They're losing $30,000+ per electric vehicle they produced in Q3. Tesla has done better, but still, Tesla's basically a luxury car manufacturer. And even they said, if you listen to their last conference call, look, for a lot of consumers in the mass market, the choice isn't about, to buy a Tesla or a Ford EV. It's about, do I buy a Tesla or, a Toyota RAV4 or something, right? A small sort of more budget-friendly car. And in many cases, it's cheaper, even with the tax incentives to buy the ICE vehicle, the internal combustion engine. So I think, I think oil prices, I think the supply and demand balance is a lot tighter than most people realize. And I think the supply side is the key. This only will end. The super cycle will only truly end. We're fighting a false dolphins, right? Because if demand comes down, you could see prices dip as we've seen, but longer term, it's the supply is the key to bringing down the prices.
Okay. Well, I can talk oil. I literally could talk oil with you for hours.
Yes.
It's such a fascinating subject, and it impacts everything.
Yes.
But let's talk. We'll just first share. Are you looking at, or what's attractive to you, or how should listeners evaluate a company that would be an attractive investment for them?
Yeah, I mean, right now, we're in a market where, the oil price is a little squishy. There are some legitimate concerns, I think, about the economy next year. I do think over the long haul, it's going to be higher. I would look at some of the bigger producers right now. I mean, I would look at, this is not very creative, but I would look at a name like ExxonMobil.
Yeah, I would too.
Yeah, I mean, they're the only ones of the majors, really, that invested a lot during the down cycle for oil. And they actually have this new Guyana project coming on stream here, or it's already on stream, but they're rolling out additional phases of growth. And so I think that's a name of a producer. They've got a dividend, a decent dividend. They don't have a debt problem. I think that's a solid name to own in the downturn, especially if it gets under $100 again a share. I would also look at the services side of the equation. I like SLB, what used to be called Schlumberger. We talked about the investment cycle. We talked about, you probably heard the old thing, who made money in the gold rush, right? It was people selling the picks and
Right.
shovels, not the guys actually out there digging around in the stream. And I think that to extent is true in the oil business. I mean, everybody will make money, but the companies that enable these very complex fields to be developed, deep water, more complex onshore fields, SLB is known for its technology. I think they're going to do well over the long haul. And that's a name that I think is not even in the middle of the cycle yet in terms of their profit margin and growth potential.
Got it. Well, let's talk about natural gas. I'm in Georgia. I believe you're down in Florida. And Georgia, there's a reason I live in Georgia. It's because of the mild winters, but it's 34
Right.
degrees out.
Yeah. We could go down in the 40s here in Florida. So.
Right. Yeah. So I thought, and I believe last time we'd spoken, we thought we'd get a decent spike up, or it was natural gas we thought was too cheap, and which we did in October. Then we had some significant sell-off, right, probably where we were last summer. What are your thoughts on, where we at in the supply demand equation? And also, how would you position yourself to potentially take advantage of, a spike up or even a gradual rise in natural gas prices?
Yeah, sure. Well, first of all, I think most people, especially looking in the US natural gas market particularly, they look at it entirely the wrong way. And the reason I'm saying that is because every day on the news, all over the internet, right? You see what's the price of natural gas? Oh, it's $2.65 a million BTUs or whatever. That's usually the spot price, but more likely the front month's futures, right? Which could be, right now it's, February, right? February. So gas for delivery next month. Well, gas for delivery next month is a lot cheaper than gas for delivery, say, a year later in February 2025. And if you look at the curves, the futures curve, the price of gas for each month, delivery each month in the future, say over the next 4 or 5 years, right? Say, 2028, 2029. What you'll see is that though the front month has swung around wildly in the last 6 months, as you said, back in June, it was low. We got a spike up. I think the high for front month was Halloween, October 31st.
It was. Yeah.
And then we sold off again, right? But the longer term portion of the curve, say beyond next summer or certainly next winter, I'm talking the winter of 2024, 2025, has barely moved, right? So the front month is very dependent upon weather conditions. So, as we all know, the weather is very difficult to predict, every day, right? If you go outside, it could be totally wrong. And temperatures, going out, 15 or 30 days in the future is almost impossible to predict. So it is very weather dependent. We had a very mild start to the winter weather across much of the United States this year. So demand was lower than normal. Inventory or storage was a little above average. Now we're starting to see some colder weather move in, as you mentioned. I believe there's some predictions now, say 14 days out, it's going to be below average temperatures across many of the key gas consuming regions of the United States. And that means, of course, more gas demand. Prices have kind of spiked recently. And so that's what causes all that volatility in the front month. But fortunately, for most of the producers, unless you're trading gas futures, where that's very important, for most of the producers, it doesn't really matter that much. I look at a name like Chesapeake Energy, for example, CHK. They hedged already more than half their, I think about 60% at the moment, their Q1 2024 production. So they hedged it months ago at much higher prices than where it's trading today. So it doesn't really matter if gas is trading at $1.99, say, or whatever in February, if they've already got most of their production hedged. And right now they are also layering in hedges for late this year and early next year, right? 2025. And they're layering in prices at $3.50, $4 a million BTU right now. because that's the price at the end of this year, early next year. Main reason for that, of course, is that apart from the normal cyclicality of weather, right? It's hot in the summer and cold in the winter, right? Obviously. There's also the LNG export story, which is kicking in towards the end of this year and into early next year. We have a lot of new LNG export terminals coming on stream here in the United States to export natural gas to Europe and Asia, where prices are still many
Crazy
times
high.
higher. Yes.
Yeah.
Yeah. We're off our highs. People say, well, the price in Europe, the Netherlands title transfer facility is down, 80%, 90% from its peak. Yeah, but it's still, 5, 6, 7, 8, 9, 10 times what it costs here in the US, depending upon exactly what lots you're looking at. So it's still very attractive to export LNG. The US is a major player, and these terminals are going to be full. They're going to be fully utilized. And in fact, they're already signing contracts to that effect. The gas is needed, if not by Europe, then by Asia. So that's going to be a major pull on U.S. gas supplies. And I think that there are a lot of companies anticipating that turn. And so what they're doing now is they're saying, okay, we're going to keep our CapEx down while prices are low. We're going to try to spend within our cash flow. But come end of next year, early 2025, we want to be ready to ramp up production to meet this growing demand. I like names with exposure to the Haynesville Shale. Haynesville Shale is in Louisiana and East Texas. So you look at it on a map, the Marcellus Shale, which is the other major gas-focused shale basin, is Appalachia. So West Virginia, Pennsylvania, parts of Ohio, et cetera. It's a long way from Pennsylvania, Ohio, West Virginia to, say, coastal Louisiana.
Right.
For LNG. We're here in Florida, right? And all that gas has to be piped down. People are pretty angry about pipelines. It's very difficult to build pipelines in the United States. And the Mountain Valley Pipeline through Virginia was long delayed and finally was only approved because, Senator Manchin pushed it through as part of a bill. So, so if you're a producer in the Haynesville, though, right, you only have to transport short distances to the coast, intrastate, inside that one state, or to friendly states like Texas, where, energy infrastructure is kind of a fact of life, right? So, I like companies that have exposure to that. Chesapeake is one example. A little higher risk play would be a name like Southwestern Energy. Chesapeake and Southwestern both are sort of two basin producers. They produce from the Marcellus, which is cheaper, and they also produce from the Haynesville, which is easier to grow because of its proximity to the Gulf Coast and the less need for pipeline takeaway capacity.
You mentioned the curve. I'm glad you brought that up. I have a really good friend who worked for the ICE here in Atlanta, and he would work predominantly with energy traders, natural gas traders. And I just asked him, what are they looking at? And he's like, the curve. Yeah. Watch the curve. So thank you for bringing that up. It's interesting too. I read an article about U.S. exports of LNG and just how we're at really record highs. My question is, you see that not only maintaining, but also growing then, just to meet the demand from Europe and Asia. Is that correct?
Yeah, I do. The demand is there, and the U.S. is the low cost provider in the world in terms of scale.
Yeah, there's a reason for that. So, meaning our exports are so high. So
yes. And, we have, our plays, our shale fields, the Marcellus and Haynesville and places like that, Permian Basin too, just very low cost of production compared to, most other places around the world. The other thing, of course, is security issue. Most countries rather in a place like Europe would probably rather buy from the United States or Australia than Russia. That was kind of underlined a year ago. And, I think that's going to continue to be the case. As I said, energy security is, for the first time in a while since the Russian invasion of Ukraine a couple of years ago, is, front page, right? It's the most important thing. A lot of countries are, for example, building LNG import infrastructure because they know that they're no longer going to be able to get from Russia. Is have to import more from places like the United States.
Yeah.
What we've seen is that really the only thing that significantly reduces U.S. LNG exports is, a facility outage, like we saw at Freeport LNG last summer of 2022 into early last year. But I don't buy the view that there's going to be too much U.S. LNG on the market. I just think that given the price of U.S. gas, the price outside the U.S., and the fact that gas demand is still growing in many of these countries. I'm assuming, for example, Germany managed its crisis by cutting off the loss of Russian gas supply by burning more coal. I'm assuming that they're not going to want to do that longer term, right?
Right.
Seeing as how that's kind of the opposite of what they're trying to do in terms of cutting their carbon dioxide emissions and promoting alternative energy. So I'm assuming they're going to want to import gas again and sort of offset, in other words, close down some of those coal plants as planned and use more gas because it's much cleaner. And then you've got Asia where demand is insatiable. I also think that it's a sort of misunderstood aspect of it is when you see more wind power plants, turbines, when you see more solar, that also means more gas demand. The simple fact is that, the wind doesn't blow at a constant speed all the time. And the power output from a wind turbine is an exponential rate. What I mean by that, if most wind turbines are designed to produce their maximum output, they're most efficient at, say, 35 miles an hour, 35 miles an hour, at, constant wind velocity. If the wind velocity halves, right, the power output goes down by almost 90% to 1/8 what it was previously. So the wind velocity goes from, say, 30 to 15, power output goes down 87.5%. Now, as you know, probably most people are aware that wind doesn't blow at constant rate all the time, and it's very difficult to predict.
Like the weather.
Yeah, like the weather. Because it is the weather, right?
Because it is the weather, right?
Yeah. And, so the storage is very expensive. It's still very, very expensive. So most countries use shadow capacity, which basically means a natural gas-fired plant that can feed power into the grid when the wind isn't blowing at a sufficient rate. So, what really cracks me up sometimes is on websites like Twitter or X or whatever it's called now, right? People will be saying, oh, well, Germany yesterday at noon, Germany got, 95% of their power from solar and wind. And it's like, yeah, great. But at 10 p.m. the same night, right, they got, 65% of their power from coal and gas. So you can't look at it in a given point in time or even the average over a month, because you still have to be able to provide for those peaks and walls in power. And that means using a fossil fuel that can feed power quickly into the grid, especially in a country like Germany, which has closed down all their nuclear power plants.
Right.
So, I think their demand is there, and it's going to be, and, people would rather buy from the U.S. than Russia, or honestly, most of the places in the Middle East.
Right.
So I think it's going to grow.
Right. Speaking of which, you brought up nuclear power. Let's talk about uranium.
Yeah.
Let me set this up with, I spoke to, it was about 4 weeks ago, Warren Irwin, a great interview, by the way. Which I appreciate about it. He didn't really want to share his macro view, if you would, because he doesn't really have one. He really analyzes companies, but he was a huge player in the uranium market. I did get out of him. He was still bullish on uranium, but he wasn't like this wild bull that most people are. What are your thoughts? And again, not to compare you to him, but it would be interesting to see where you're at in relationship to him, where uranium's going intermediate and longer term, and intermediate, not tomorrow, or maybe not even this year, but over the next few years to longer term. And is that run over or the big run over? And how would you really play that?
I don't think that the run is over. These uranium bull markets, we've seen a few in the last, 40, 50 years. They tend to go in sort of spurts and phases. And I think there's more upside longer term. There are a lot of fundamental intermediate to longer term drivers out there. You probably saw the statement that came out of the COP climate conference a few weeks back in early December. A lot of countries are pledging to rapidly and significantly increase their nuclear power capacity. I think that is a positive for demand. We're seeing Japan restart many of their idle nuclear reactors because they came to realize that they don't have a lot of natural resources in Japan, as we talked about, wind and solar are intermittent. They need some baseload power. And so we're seeing the demand side of the equation ramp up. On the supply side, we've seen some of the big producers in the world, like Cameco in Canada, have missed their production targets, are having to buy material on the spot market, right, to meet their contracts.
That sounds widely bullish to me.
Yes, it is. And I think longer term, that's an issue. Now, you do have the last uranium bull market basically ended because of Kazakhstan. And Kazakhstan rapidly increased their production of uranium using in situ leach, pumping water underground, dissolving it, and pumping it back to the surface, which was a very cheap way for them to produce uranium in large quantities. But Kazakhstan isn't going to grow to the extent that it did, at the end of the last uranium bull market, 15 years ago, in the next 5 years. They could grow a little bit, but they already are kind of at a high level of production. And the chances of them, increasing the same degree that over the next few years as they did at the end of the last bull market is low. I don't see a lot of other countries out there sort of waiting in the wings with major supply as Kazakhstan was, again, at the end of the last uranium bull market. So I think that's a little positive for uranium. Mine production has not covered US or global uranium demand for years, right? Most of the supply, or a lot of the supply, is filled in from stockpiles or secondary sources. So I think that's all constructive. I think it's constructive to see a company like Cameco signing these long-term deals to supply uranium, which means that the utilities want to secure that supply. So I think that's all bullish longer term. Yeah, in the short run, back in September, we did recommend in some of the trading publications, particularly taking some profits on stocks like Cameco.
Let me interrupt you. Last June, when you were on with me, you were really bullish. You called it. So you're not giving yourself credit. So listening and watching this, you nailed it. So go ahead.
Well, thank you very much. Yeah. We were in those names. We recommended Cameco, in particular, and Cameco did very well. I did think they got a little overcooked, if you will, at one point in the fall. The stocks were very overbought. The story went from being kind of a backwater play within energy. I'd have very few people ask me about it when I'm speaking at conferences, say a year ago, to becoming, I was at a conference in Orlando a few weeks or back in late October, early November, and literally half the questions were about uranium.
Right.
So it's no longer the sort of undiscovered backwater market that it was, say, even 6 or 8 months ago, or 9 months ago. But I think the supply demand balance is still there. I think that it's just a group that you want to be careful to buy on pullbacks, and just understand you may not see the sort of speed of gains that you saw at one point earlier this year, just because it went from an underweight sector for most people to something that was very much in the news and very much front burner.
Yeah, about that, it was surprising to me how much it ran, if you would. And it's one of those things where I almost see, and I'm not making a prediction here, but I can see the same thing happen with the oil, if you would, is just that the supply and demand is not demand, but the supply is so out of whack that it's just going to, wherever the price does eventually end up, it's going to go really quick. So that, I guess that's my thoughts on that. Can you give us any names that you're looking at for uranium and how to play the uranium market?
Sure. I'd say 3 of the easiest ways. One is Cameco, symbol CCJ here in the US, CCO in Canada. They're a big producer, one of the largest independent producers other than, Kazatomprom, the Kazakhstan producer. But, they're a, sort of the blue chip, if you will, of the sector. It's a well-run company. I'd also, honestly, the smaller uranium producers, there's some good names there that have been around for a while. I do think uranium prices, by the way, tend to get back to that point. I think you need to see that $90, $100 a pound if you want new mines to come on stream, because just like oil, I said, you need that higher for longer price to incentive the level of investment needed to bring new supply online. You need the same thing in uranium. It's just $90 a pound, $100 a pound, rather than say, $90 a barrel for oil. And so I do think that some of these smaller producers that have limited production already, or some mines sort of that could be brought on stream in the next few years, may do quite well. Rather than picking individual names, because it's a risky business, right? I would look at an ETF like URNJ, which is the Junior Global X Junior Uranium Miners. Has a wide list of these smaller mining companies. It's a name that we've recommended in the past, and we're actually adding to it down where it is now. It's come off its highs. I think that could be a good way if you're looking to get sort of broad exposure. I don't normally like ETFs, to be honest with you, in the energy sector, because they own sort of the good, the bad, and the ugly of the sector. So for natural gas, I'd much rather pick a name like Chesapeake, or Southwestern or EQT, rather than a name like, Comstock, right? Which is another producer out there that's in a lot of the ETFs. But with uranium, certainly there are some smaller independent names, smaller producers, more speculative names that will make a lot of money. There are also some that are going to not be around 5-6 years from now, right? Just like the last uranium bull market. I kind of do like having a basket of them in that Global X Uranium Miners ETF.
Got it. Okay. Excellent. We're going late on time here. I know we wanted to talk a little bit about coal. Just briefly, give me some thoughts on coal. We mentioned Germany having to solve their energy problem last year by importing a bunch of coal. I know still, and you were wildly I don't want to say wildly bullish, but you were bullish and thought coal was interesting the last time we spoke.
Yeah.
What are just some 30,000 foot views on coal?
It's amazing to me how, people act like, that alternative energy is taking over the world. I mean, I call them the big three fuels, right? You have oil, natural gas, and coal. In 2010, they were, I think, a little over 86% of global energy demand. Now we're a little under 82%. So in the last 13 years, right, we've seen very little decrease in any of those three fuels. The only thing that's happened is natural gas has expanded a little bit, coal has contracted. Mainly that's because of less coal consumption in developed countries like the United States. And I think that will continue, right? Because you're going to see, why not use natural gas here in the US where prices are cheap? But a lot of emerging markets don't have that luxury. India, for example, a lot of people don't have electrification. It's people in the US sit here and say, well, everybody has electricity, right? And so, they say, India burn less coal. They can't afford to do that. And unless you expect them to be in a long-term sort of economic depression, they're going to keep building these new coal plants. So the idea that coal is dead or is going to be phased out, I think is dead wrong. You're going to see it continue to be a portion of the energy mix for years to come, decades to come. I think in the developed world, natural gas can offset a lot of that, but you're still going to have these emerging markets using more coal. India, China, and then of course, smaller emerging markets that are coming up now. And it's all part of the basic human evolution, right? People, as economies grow, as they develop, people use more energy. Going from an emerging market to a developed market is extremely energy intensive, because not only does say your overall population grow, but you also have more energy consumption per capita. So I think it's absolutely irresponsible to think that coal's going away or talk about phasing it out. It's not going to happen because I don't think a lot of these countries are going to say, you know what, we're willing to sacrifice our own economy for, some goal of phasing out coal. So I think coal is going to continue to be a force, and it's going to surprise people how durable it is.
Yeah, I would agree with you. So wrapping up here, can you give the listeners and viewers just where do they find you, and just briefly just tell us about your services, and if they're interested in working with you, how do they do that?
Yeah, sure. Well, my main energy focused service is called Energy and Income Advisor. It's at energyandincomeadvisor.com, all spelled out. Um, we publish issues every month, usually twice a month. We have a model portfolio in there. We cover the gamut, everything energy from oil, natural gas, producers, services companies, uranium, also alternative energy. We cover the waterfront out the sector. Um, we actually are now running a 60-day free trial. If you'd like to go to the website and check it out, you can sign up and get 60 days risk free. I also have a Substack column I write over on substack.com called The Free Market Speculator. And I publish totally free commentary there once or twice a week. I do also offer a model portfolio for a relatively small upcharge. But if you want to subscribe to that, just go there, select the free version, and you'll get a lot of commentary. I cover energy a lot, not all the time. I do talk about the economy and other things, but cover energy there several times a month. So if you're interested in following along with some of the names I talked about today, you can check it out there.
Excellent. I will put all of this in the show notes, both on the podcast and on the YouTube channel and on the site. Elliott,
Thank you.
it was an absolute pleasure. Thank you so much. We'll have you on again, hopefully sometime in the next quarter or two, just to get a recap and see where we're at moving forward. But
Thank you very much. I appreciate it.
Yeah, well, I appreciate it. You're so gracious and very, very insightful. I'm sure our listeners can use a lot of this information.
Thank you.
Thank you.